The US government will run out of cash in exactly 7 days and be unable to pay its bills and may even default on its debt. This is according to the Treasury Secretary Janet Yellen, who says that the 1st of June is the potential deadline for a debt default. So what does it mean to us as investors of stocks as well as bondholders? And how could we actually profit massively from a potential debt default? Let's find out in this video. First, a couple of facts. First of all, the US government has no problem paying its bills because it can just print money. But it has this self-imposed debt limit that it set back in 1917 to prevent it from borrowing too much. But the problem is that they keep having to raise the debt ceiling every few years. In fact, since 1960, they have raised the debt ceiling 78 times. So it's nothing new. They just have to raise it again. But every time it comes down to raising the debt ceiling, the Republicans and Democrats have to both agree to do it through the House and the Senate. And the problem is, for example, now that Democrats are in control of the White House and the Senate, the Republicans are using it as a negotiation tactic that if you don't cut your spending, you don't agree to certain terms, we're not going to agree to raise the debt ceiling. So that's always this negotiation where they play chicken with each other. If you don't agree to my terms, I won't raise the debt ceiling. Agree to raise the debt ceiling, right? So it always comes down to the very last minute where they would eventually raise the debt ceiling. But before that happens, the markets get very nervous, the markets tend to sell off, and sometimes if it gets a bit close, the US debt could in fact be downgraded by the rating agencies, which is what happened in 2011 that caused the market to drop 20%. So could this happen again this time? And if it does, how could we take advantage of it and profit from this short-term panic, right? Now, first, a couple of facts. Since the 19th of January, the US government has actually already hit the debt ceiling of $31.4 trillion. So for the last 5 months, the Treasury Department has actually been taking extraordinary measures to really pay their bills because technically they already ran out of cash, but they're digging it from all over the place. Right? But right now, what Janet Yellen is saying is that, okay, 1st of June is the date where we've run out of cash. There's no way I can get it from. And if we don't, raise the debt ceiling, we're going to default on the debt. It's going to cause a catastrophe. Although some people are saying that she's bluffing, that the actual date, the X date is something like between 2nd to 13th of June. But whatever, it's coming really close. Now, some people have always asked me, Adam, why are you not concerned about the ballooning US government debt, that you keep investing in US stocks, you hold a lot of US assets? Aren't you worried that eventually it's going to blow up? Now, I'm not worried at all for a few reasons. Number one reason is because remember that the US government, technically, they can just keep printing money forever and to pay their bills, right? But then you may say, but now their debt to GDP ratio is crazy. Their debt to GDP ratio is 129%. So they've got 29% more debt than their GDP. Isn't that unsustainable? Not really. Let me explain why. Now, if you've been hearing recently, right now, where's the hottest place to invest in? Japan. The Japanese stock market is now really hot. Everyone is rushing to invest there. And recently, Warren Buffett has made huge investments into Japanese companies. Now, do you know what is the Japanese debt to GDP ratio? It's way higher than the US. It's 225% versus the US, which is only 129%. So the point is that I wouldn't be too worried about this high debt to GDP ratio because it does not mean that you can't find great companies to invest in within that market. Now, some people will be very curious to say, okay, so the US government owes $31.4 trillion. But who does it owe it to? Who are the creditors? Who is holding all this US government debt? Now, what's interesting is if you look at the breakdown, 22% of US government debt are held by local US governments. All right. So in other words, it is intra-governmental debt that makes up about a quarter of all US public debt. So in other words, who owes the US government? The US government, right? So it's kind of like left pocket, right pocket. Now, that's 22%. 78% of US government debt is held by the public. Now, who's the public? Here's the interesting thing. Out of the public, 2/3 of the public debt is held by domestic holders. In other words, American institutions like mutual funds, US mutual funds, US depository institutions, pension funds, state and local governments, and the Federal Reserve themselves. Do you know that the Fed makes up 35% of domestic holding of US government bonds? So in other words, 22% of government debt is held by local US governments, and 2/3 of the remainder, which is 52% of government debt, is held by domestic holders, of which 40% is the Fed. So in other words, a total of 74% of US government debt are held by Americans. So about $900 billion of interest that's paid by the US government goes back to their own American institutions. It goes back into the system. So it's totally left pocket, right? And only about 26% of holders of government bonds are foreign holders, of which Japan is the largest holder, followed by China, followed by the UK and the rest of the other countries. So what happens if the debt ceiling is not raised in time? Well, the US government can't pay its bills, all right? So a few things are going to happen. Number one, if they can't pay their bills, then they would prioritize only paying government institutions that are necessary. So your parks, museums, non-essential government services will shut down. That's called a government shutdown. Has it happened before? Many, many times. It's not something new. It's actually quite common, right? So, but the greater danger is that if the US government is not able to pay interest on the government bonds, so that would lead to what we call a debt default. And that is the thing that's quite catastrophic, right? So if the government defaults on the debt, what's going to happen? And people are going to demand higher interest rates on US government debt because they deem it as to be more risky. So that will dramatically increase the yields on government treasuries, increase interest rates, and of course make it more difficult for businesses to borrow money because interest rates go up, more difficult for consumers to borrow money. That leads to reduced consumption, and that would trigger a severe recession or depression. And of course, that's the nightmare scenario. Now, the US government has never ever in history defaulted on its debt ever before. But it could happen, you never know, right? So what's the probability of default? So according to JP Morgan Macro Research, currently the probability of default is, this gray line over there, 2023, is about close to 4% chance of default. Okay? Now, so I don't think they're going to default, right? So I don't think they're going to default. I think it's a very low probability, but they don't have to default for the market to have a big sell-off. As long as there's a concern of default and the rating agencies downgrade the US government debt, that could trigger a sell-off in the market. So we're going to talk about that and how we could, profit in that scenario. So first of all, let's look at government shutdowns. Now, I've shown this table before to show you that, if the government runs out of cash and it can't pay the bills, it'll start to shut down its non-essential operations. Nothing new, very common, has happened many, many times before. You can see back in 81, 82, 83, 84, 86, 87, 1990. Most recently, 2018, the US government shut down for 34 days. Now, are US government shutdowns bad for the stock market? Well, not really. The market doesn't really care about it. It's like, who the hell cares, right? So you can see that during all these government shutdowns, the S&P 500 really did not move very much during that period. So this will not trigger a big sell-off in the markets. Now, throughout the entire history of this debt ceiling problem, there's only 1 year where it triggered a mini crash in the markets, and that was 2011. That was the only time, right? So what happened in 2011? Well, in 2011, S&P, now there are three main rating agencies, S&P, Fitch, and Moody's. Now, of the three rating agencies, S&P decided to downgrade the US government debt from AAA rating to AA plus rating. And it's the first time that happened in 20 2011 under Obama, right? So that was one of the catalysts that caused the market to drop 20% at the time. Now, this was not considered a bear market, because a bear market, the market has to close 20% below the high. But in this case, it didn't close 20% below the high. It just touched 20%, it touched, and then it flew back up again. So could this happen again this year? I think there is a possibility it could happen again this year. If another rating agency decides to downgrade the US debt, and already Fitch, which is one of the rating agencies, has warned that we may downgrade the US debt if they do not raise the debt ceiling fast enough. So this came out a couple of days ago. Fitch puts US rating on negative watch as debt deadline looms and is threatening to downgrade the US debt. So again, it's not the shutdown that's gonna cause a sell-off. It is the downgrading of the US debt, which again happened in 2011. Now, let's go back to 2011 and let's see actually what happened, right? Now, what is interesting is that if you take a look at 2011, they actually downgraded the US debt after the debt ceiling was raised. Not before, after, right? Now, during that time, the deadline back in 2011 for the government to run out of cash was the 2nd of August. That was the deadline. So they actually raised the debt ceiling one day before the deadline, right? But it didn't matter, okay? So you can see this candle over here. Let me point, right here, this candle. This was the day that they raised the debt ceiling. But what happened after they raised it? The market still dropped 16%, even after they raised it, right? And after the debt was downgraded by S&P, which was on this day, 5th of August, then the market dropped some more. Now, you may say, why? I mean, they raised the debt ceiling, right? Why did it drop after they raised it? So you can understand that a lot of these market moves are manipulated by market makers and big institutions to kind of like scare the retail investors or to force them to capitulate, right? To take out the stop losses, to flush out the weak holders before the market goes higher. And I suspect that a lot of market makers and a lot of these institutions may use this as an excuse to flush out the weak holders again for one last time, a final shakeout before pushing the market higher. Now, I'm not saying it's going to happen because I don't know. I can't predict the future, but again, it could happen. So if it happens, how could we take advantage of it and not be scared off by it? And how could we profit from it? I'm going to talk about that in a short while. But again, let me show you this chart that was actually shared by Mark Minervini, who is a very successful trader in the markets. And, so one of the things that he agrees, or rather we are in agreement, is that we have already finished the bear market last year. The bear market is over. We are in a new bull market. All right. So that's something that he buys as well, right? But the question is that, remember that in the start of a bull market, it's not always a straight line up in a bull market. Sometimes at the early stage of the bull market, they may do a final shakeout of weak hands before resuming the bull market, right? If you take a look at the S&P 500 right now, you can see that we are actually consolidating within a tight range. And it's attempted to break out of that range for the last few days, but it kept on staying within this range. Now, again, if this debt ceiling becomes an issue and we do get that downgrade from Fitch or whoever, then we may see something like what happened back in 1991, where we've got a final break of the consolidation and a final shakeout to scare the weak hands before the market takes off higher. Now again, no one can predict whether this is going to happen or whether we're just going to break out from here. But my point is this: if the next month we see a sell-off of 15-20% down, I'm not going to panic. In fact, I'm going to get very excited. Now, I don't mean to be an asshole, but I'm secretly hoping that this is going to happen. Let me tell you why, all right? Because so far this year, I've only invested 20% of the money I wanted to invest in the companies that I love. Because every year, I always put in a certain amount of money into the markets. And this year, I've only invested 20%. Why? Because many of the companies that I want to buy, it kept going up too fast that I can't buy it anymore because some of the stocks that I love are no longer undervalued. So, the bastard in me, the asshole in me is kind of like hoping that we get one more last shakeout in June or maybe even in September so that, the stocks can get a bit fairly priced again so I can like load up more shares. At the same time, if this happens, this is going to spike the volatility, giving me a chance to sell more put options. So I like to sell put options, cash secured put options, or credit spreads when volatility is very high because that's how I earn a lot of premium in the markets. And when it goes up, that's when I make a lot of profits from my short put option strategy, right? Now again, I can't predict the future. I don't know if this is going to happen. But like I said, if it happens, I think it's a blessing in disguise for us to pick up more shares of high quality companies as well as take the chance to sell cash secured puts or sell some great bull put spreads to make great premium as the market rebounds higher. Now, in the event that the US debt gets downgraded or they raise the debt ceiling too late, there are three things that I foresee is going to happen. And this is how you could position yourself to profit from these three things. Number one, the VIX is going to spike up. Okay, so what's the VIX? The VIX is the volatility index. Now, currently the VIX is at about 20. During the 2011 debt ceiling crisis, the VIX spiked to a peak of 48 from 20. So if you think that this is going to happen, this panic sell-off is going to happen, this downgrade is going to happen, you could buy call options on the VIX futures. Or even better, buy a VIX bull call spread, which means you buy a call option and sell another call option to finance the first call option. That will make it even more profitable in terms of return on capital. So let me show you how I would set it up if I wanted to bet on this scenario, which I'm still thinking about it. All right. So this is the VIX chart. And again, remember that back in 2011, during that panic, the VIX went from 20 all the way to 40, if I'm not wrong. Was it 40? 48. My God, it went from 20 to 48. So you could make a lot of money betting on the VIX call options, the VIX futures call options. So first of all, let me go to the option chain. Now, which expiry date should you choose? Well, if you look at history, let's take a look at history. Now, we can see when did the market really panic, okay? Now, the deadline at that time was the 2nd of August. And you can see the main panic happened on the 5th of August, right? Between the 1st to the 5th is where the panic happened. So if it plays out the same this year and the deadline is the 1st of June, then the panic should happen between the 1st of June to maybe the 5th of June, around that area, right? So we don't want to buy a call option that expires too far beyond that. We want to buy a call option that expires within that range. So I could choose a 7th of June, which would give us enough time, right, to benefit from this panic and the VIX shooting up. So I'm going to buy a call and sell another call to create a bull call spread on the VIX futures. So an example could be I buy the 20 call option, which is this one over here. Yeah, I'm going to buy the 20 call. And if I buy the 20 call, it's going to cost me about $1.82, and I'm going to sell the 30 call. All right, so I'm just going to do that. Buy a vertical spread. There we go. So buy the 20 call, sell the 30 call. There we are. Okay. So how much is it going to cost me to enter the trade? It's going to cost me $1.17. Now remember that one contract of options is 100 shares. So multiply by 100. So what's the total capital? $117 per contract. All right. So you can see what is the risk to reward ratio. So the most I can lose if the market doesn't panic, if the market is like, okay, let's go up, then the most I can lose is $117, right? That's my maximum loss. But if the market panics and the VIX shoots up, I could make a profit of $800. So that's not a bad bet, right? You're risking $100 to make almost $900. Now, if you take a look at what the option profit and loss chart looks like, this is what it looks like. There we are, right? So again, currently the VIX futures is close to 20. That's where we are now. And between now to the 7th of June, if there's panic and the VIX shoots up, right? If it shoots all the way up to, you can see 30. We are not even going to go for 48, right? If it just goes to 30, you can see our profit, right? Our max profit would be about $884. Okay. Now, again, it may not go all the way up there. It may go up to maybe 25, VIX at 25, and we could make maybe about $400, right? So the higher the VIX spikes, the more money we're going to make, right? Now, again, what's the chance of it happening? It's not high, all right? So again, only if we get a downgrade, then we have this panic, right? But if the market doesn't panic and the market doesn't crash, then it won't go up and it may drop. And how much do I lose? I lose $116. So it's not a bad bet. It's kind of like playing a bit of the lottery, right? Okay, so that's one way you could bet on making quite good money on this coming panic. That's one way. Another way is to buy put options on the US market. Now, what's interesting is that during the last default, the Russell 2000 dropped more than the S&P 500. Remember, the S&P 500 are the large companies, the big companies, right? So yeah, they will drop in an event of a panic. But what will drop even more are the small companies. Small companies tend to get hit harder during crisis. So to bet against the small companies, you could buy put options on the Russell 2000 index or the Russell 2000 index ETF. So during the 2011 crisis, the S&P dropped 17% at one stage, but the Russell dropped 24%. So you could buy, again, put options on the small cap ETF. Here's an example. So the IWM is the Russell 2000 ETF. It is currently trading at $175. And again, if you want to bet that it could crash during this debt ceiling crisis, then the next level of support would be at about 162. All right. So from 175, it could crash to 162 or even lower. But that could be your initial target of 162. So again, how could you trade it? You could use options in order to have minimum downside, but maximum upside if you are right. So again, I would choose maybe the 7th of June expiry, since that is when the shit's going to happen, or by then the shit will happen, all right? And I could buy a put option. Let's say I could buy a put option at about 175, and I could sell another put. I could sell another put at, okay, there we are. So that's $2.22 per share times 100. The contract value be $222. And let's see if this is a worthwhile trade. All right, it's not too bad, right? So again, if you enter this trade and the market doesn't crash, you could lose $200. But if the market crashes, you could make $700. So that's kind of like a 778 divided by 222. That's kind of like a risk reward of 1:4, risking $1 to make $4. Again, that's betting that the market will drop from 175 to 165 by the 7th of June. Again, it's not a bad bet, although I would say it's a low probability bet, but it's a pretty good risk to reward ratio. Now, the first two bets were betting that all hell will break loose. Now, what if we think that hell is not going to break loose, that they're going to find a resolution in time and everything's going to be okay? So if you think everything's going to be okay, here's another interesting trade that I'm looking at as well. So you can see that in 2011, what happened was after they raised the debt ceiling, the 10-year treasury yield began falling. Okay, so what does that mean? Because once they raise the debt ceiling, people are now thinking, okay, everything is fine. So they dare to buy bonds again. So by buying bonds, treasury bonds, bond price goes up, the treasury yield goes down. It's the opposite, okay? So what I noticed recently is that treasury yields have been rising. Let's look at the 10-year treasury yield. Okay, so can you see that recently it's been rising? Whoa, right? The 10-year yield has been rising. Now, why did this happen? This happened because people recently have been selling bonds. They've been selling the US government bonds, afraid of the default. So by selling the bonds, the bond price goes down, the yields go up. So you can see that as the yields go up, the TLT, which is the US government bond ETF, has been falling. Can you see it's been falling? Whoa, right? And I'm watching this support level here at about 98.88. So I'm hoping that it's going to get to this support level. And the moment this debt ceiling issue is resolved, what do you think is going to happen? That's right. This is going to fly up again as people get confident and start buying US government bonds again. Then this will start to go up again, right? So this is another trade I'm looking at where I'm hoping the next few days it could hit this support level and I start to take a long position on the TLT. And to me, it's going to be like a very short-term trade. So I may use call options as well, bull call spread options. So again, this is how I may set up the trade. So again, what expiry would I use? I would use, for example, the 9th of June, right? There's no 7th of June, so I'm going to use 9th of June, and I'm going to buy a call at, let's say, 100, and I'm going to have a profit target of somewhere, maybe at about, let me just check where it was initially, 108, that's right, okay? So I'm going to bet that it's going to go up to about 108. Why 108? Because that is where you can see there was a very strong level of resistance here, all right? So if we get that, we could fly back up to this resistance, right? So we are buying the 100 call and selling the 108 call. So again, this is a bet, right? It's a speculative bet. And in bets, you don't win all the time. Sometimes you win, sometimes you lose in these bets. But you always want to ensure that you're risking $1 to make more than $1. So even if you're right half the time, you're still making very good money. Because when you're wrong, you lose $1. But when you're right, you make a lot more than $1, right? Okay, so we are buying the 100 call and selling the 108 call. Let's see what that would look like. Okay, so I'm going to buy this vertical spread, buy the 100 call, sell the 108 call, and there we are, right? So how much would it cost? It would cost me $172 per contract, okay? And let me just show you the risk-reward ratio. You can see that, okay, if it doesn't go up, right, then I could lose a maximum of $172. That's my maximum risk. But if it does rebound, then I will make a maximum profit of $628. So 628 divided by 172, that is a risk-reward ratio of 1 is to roughly 3.6. Now, is that a good bet with a good risk-reward ratio? It's not bad, right? So you can see that there are many ways that you could profit from these events, yeah? Now, again, please do not trade options or do not trade at all unless you learn exactly how to do it properly. So I'm not sharing this as a recommendation or as a trade that you should do. I'm just sharing with you my thought process, how I look at the markets, how I look for opportunities, how I construct all kinds of trading strategies. And again, I always tell people that please do not trade with real money, with real money until you fully educate yourself. And you can do it through our Piranha Profits option courses and stock trading courses and everything, right? You equip yourself with all this knowledge and you can make a lot of money in the markets without having been right all the time. You just have to be right once in a while and you can make a fortune because, again, we are risking $1 to make a lot more money in these trades. Hope you enjoyed it and I'll see you guys in the next video. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.